Most traders believe speed wins. They watch the tape, see momentum, and click. They're wrong. The fastest traders aren't the ones making the most money. They're often the ones bleeding it fastest. Here's the brutal truth. 87% of day traders lose money within the first year. Not because they're slow, because they mistake velocity for vision. You've probably felt it. That electric moment when the market moves, your heart races. You see a setup forming. Every fiber screams, "Act now." And that's exactly when amateurs crack. They trade the adrenaline, not the signal. A professional trader sees the same move and does something radical. She waits. Not passively. She waits with a plan. She's already mapped the entry, the stop, the exit. She knows her position size before the trade even exists. She's just waiting for the market to confirm her thesis. Speed is a trap. It feels like control. It feels like skill. But ask yourself, when was your worst trade? Odds are, you made it fast. The best trades, they usually came after patience. Jesse Livermore, one of history's greatest speculators, spent more time not trading than trading. He'd sit, watch, wait for what he called the pivot point, the moment when the market showed its true intent, not just noise. When that moment came, he moved decisively. But the decision had already been made in silence. The quick trade formula isn't about speed. It's about position patience. It's about knowing exactly what you're looking for, sizing appropriately, and then having the discipline to strike when conditions align, not when your emotions align. In the next few minutes, I'm going to break down the exact framework that separates pros from the tape-watching crowd. You'll learn the 3 non-negotiable rules that make fast trades actually work. You'll see why doing nothing is sometimes your best position. And you'll understand why the traders making real money often feel like they're barely trading at all. But here's the thing. Knowing these rules and living them are 2 different worlds. By the end, you'll have both. The question isn't how fast can you trade. The question is, how disciplined can you be when speed is screaming at you? Let's find out. When I cite that statistic, 87% of day traders lose money in year 1, I'm not using it as shock value. I'm using it as a diagnostic tool. Think about what that number reveals. If speed was the edge, if reflexes and reaction time separated winners from losers, then we'd expect the fastest, most alert traders to be the winners. But they're not. They're overrepresented in the 87% who fail. Why? Because speed without structure is just expensive noise. A trader sitting at his desk, palms sweating, eyes locked on 5-minute candlesticks, clicking in and out of positions throughout the day. He feels like he's working. His activity level is high. His adrenaline is pumping. His brain is getting dopamine hits from the action, but his account is bleeding. The professional trader? She sits quietly. She watches. She waits hours, sometimes days, for her setup to appear. When it does, she executes in seconds. But those seconds are backed by weeks of analysis, months of pattern recognition, and years of discipline. The amateurs see speed and interpret it as skill. They see activity and interpret it as productivity. Neither is true. This is the central psychological trap that Chapter 1 must hammer home, because it's where 90% of traders get stuck. Velocity is movement. It's the number of trades per day. It's how quickly you enter and exit. It's the adrenaline-fueled illusion of control. Velocity is seductive because it feels like you're doing something. Your broker's system is lighting up. Your P&L is fluctuating. You're engaged. You're active. Fission is the opposite. Vision is the ability to see what the market is actually telling you, separate from the noise and your own emotional projections. Vision is recognizing that 80% of the price action on a 5-minute chart is noise, and the 20% that matters usually takes hours or days to reveal itself. The professional trader has invested months studying what real setups look like. She's seen hundreds of false breakouts. She's felt the sting of entering too early. She's learned that the market telegraphs its moves, but only to those patient enough to wait for confirmation. An amateur trader, by contrast, is still trying to predict. She's looking at a chart, finding a pattern, and saying this should go up. She's confusing pattern recognition with probability. Recognizing a pattern means you've seen it before. It doesn't mean it will play out the same way this time. The market is not a machine. It's millions of actors with different intentions, capitals, and time horizons. Here's a neurochemical truth that traders almost never discuss. Fast trading releases dopamine and adrenaline. Your brain rewards quick action, especially when it results in any win, regardless of size. A trader makes 5 quick trades in an hour. 3 are small losses, 2 are small wins. Net, slightly negative. But his brain registered the wins. It got the dopamine hit. It felt like activity, like skill, like mastery. A trader waits 3 hours for a high probability setup. She enters. She's right. She makes the same dollar amount as the quick trader made net, but she made it on 1 trade. Which trader feels more accomplished? Often the quick trader. Why? Because the brain rewards frequency and stimulation, not efficiency and results. This is why the amateur's worst trades are almost always fast trades. He's in a state of heightened arousal. His judgment is clouded. He's oper. Aiding from the reptile brain, threat, reward, not the prefrontal cortex, logic, planning. The professional recognizes this and builds her system around it. She removes the ability to make fast, emotional trades. She uses pre-planned stops. She uses position calculators. She uses alerts. She structures the environment so that her best instincts, waiting, confirming, sizing small, are the path of least resistance. One of the most counterintuitive ideas in this chapter is the term positioned patience. It's not passive waiting. It's not I'll wait and see what happens. It's the active state of being ready while you're waiting. A professional trader is positioned because she's already decided what setup she's looking for, what confirmation would look like, what her entry price would be, what her stop loss would be, what her position size would be, what her exit targets would be. She's done all the thinking before the market presents the opportunity. So when the market moves, she doesn't need to think. She just needs to recognize. And recognition is fast. This is the inversion that changes everything. The amateur thinks, setup appears, I analyze, I decide, I execute, slow and emotional. The professional does, setup appears, I recognize, I execute, fast and mechanical. The speed comes after the thinking, not before it. This is why professionals can move quickly and still be disciplined. The discipline isn't in the execution, it's in the preparation. Jesse Livermore's concept of the pivot point is more than a historical anecdote. It's a principle that modern traders often rediscover, painfully and expensively. A pivot point isn't a support or resistance level. It's not a technical indicator. It's the moment when the market proves that a move is real, not just noise. Think of it like this. Price approaches a support level, bounces. That's a setup. But many set. Ups fail. Price comes back down and breaks through support. However, when price bounces and holds above the level and begins to accelerate upward, that's the pivot point. That's when the market has given evidence that the bounces is real. Livermore would wait for that evidence before risking capital. He'd watch the price action. If it behaved as he expected at the pivot moment, he'd move. If it didn't, he'd wait for the next setup. This patience, waiting for proof rather than entering on hope, is what separated him from the traders who thought every technical level was tradable. Chapter 1 establishes the foundational inversion that defines the entire quick trade formula. Speed is conventionally understood. Fast clicks, high frequency, adrenaline-driven action is the opposite of profitable trading. The 87% statistic anchors credibility in diagnosis. It tells viewers that the problem isn't the market or bad luck. It's a fundamental misunderstanding of what speed actually means in a trading context. The chapter contrasts 2 neurological states, the amateur's excitement-driven, dopamine-fueled rapid-fire trading versus the professional's calm, pre-planned, confirmation-waiting approach. This isn't just a difference in tactics. It's a difference in how the brain is being used. The Livermore principle of pivot point patience transforms waiting from passivity into active readiness. Viewers learn that the professional isn't doing less. She's doing the thinking before the market reveals the opportunity, so her execution can be fast without being emotional. The paradox of positioned patience inverts the speed equation entirely. The professional can move quickly because she's waited and planned. The amateur is slow because she's trying to think while trading. By the end of Chapter 1, viewers understand that the quick trade formula isn't about trading faster. It's about executing prepared decisions quickly and preparing those decisions during quiet, patient periods of waiting. The closing question, how disciplined can you be when speed is screaming at you? plants the discipline theme that will be operationalized in chapters 2 to 5, position size, confirmation, exits, architecture, and synthesized in chapter 6. A trader named Marcus walked into a room with a $50,000 account. He'd been studying for 6 months, charts, patterns, strategies. He felt ready. On day 3, he saw a textbook breakout. Perfect setup. He risked $5,000 on a single trade, 10%. Of his account, it worked. He made $2,500. Drunk on that win, he did it again. And again. By day 15, a trade went against him. That same 10% position, gone. His confidence shattered with it. This is where 90% of traders fail before they ever truly begin. The professional does the opposite. She risks 1 to 2% of her account per trade, maximum. Not because she's timid, because she understands a mathematical truth amateurs ignore. You can recover from small losses, but large ones compound into oblivion. Think about it. Lose 50% of your account, you need a 100% gain to break even. Lose 10%, you need 11%. The math gets ugly fast when you're chasing losses. Position size is the invisible guardrail that keeps you in the game long enough to actually become good. Here's the professional's secret. She sizes before she trades. She decides, I'm risking 1% today. My stop loss is 50 pips, so my position is X contracts. The entry is almost secondary. The position is already sized for survival. If she's wrong, it stings. It doesn't eliminate her. This flips the psychology completely. When your position is small, losses don't trigger panic selling. You can think. You can hold good trades through noise. You can exit bad trades without rage. Amateurs do it backwards. They decide the position size after they find the setup. This looks amazing, so I'll go big. That's addiction, not trading. The rule is simple. 1 to 2% risk per trade, always. It's boring. It feels slow. It absolutely works. Marcus learned this the hard way. After blowing up twice, he rebuilt with a 1% rule. Slower gains, sure, but consistency. Real wealth isn't made in single trades. It's made in the 1,000 small decisions that keep you alive. Now here's the next piece. Most traders miss entirely. Even the right position size doesn't matter if you don't know where to enter. That's where the next rule changes everything. But before we get there, let me break down exactly why this 1 to 2% doctrine is non-negotiable. Because the mathematics of compounding recovery are so brutal that they deserve their own deep examination. When you lose 50% of your account, you don't just need a 50% gain to break even. You need 100%. Why? Because that 100% gain is calculated on your remaining half. If you had $100,000 and lost 50%, you have $50,000. To get back to $100,000, you need to make $50,000 on $50,000, which is a 100% return. Most traders don't grasp this intuitively until they live it. They think I lost half, I just need to make half back. Wrong. The math compounds against you. This is why position sizing isn't conservative, it's essential. It's not about being cautious or timid. It's about respecting probability in mathematics. The traders who size at 5 to 10% per trade aren't aggressive. They're mathematically illiterate. They're taking on asymmetric risk where the downside can eliminate their entire bankroll before the upside ever has a chance to prove itself. Consider the journey of a trader with $50,000 who risks 10% per trade versus one who risks 1%. The 10% trader will experience larger swings. In a good month, he might make $15,000. In a bad month, he might lose $12,000. Those are exciting swings. They're emotionally arousing. His brain gets stimulated. But statistically, he's also one bad week away from a 50% drawdown, at which point he needs a 100% recovery just to break even. How many traders have the psychological fortitude to stay disciplined while trying to double their reduced account? Almost none. The 1% trader, by contrast, makes smaller gains per trade, maybe $500 per winner instead of $2,500. But his position is alive. A 20-trade losing streak wipes out only 20% of his account. He can survive it. More importantly, he can think during it. He's not in panic mode. He's not making emotional decisions. He's reviewing his process, adjusting his entries, and preparing for the next winning streak. This psychological difference is what separates traders who blow up twice and give up from traders who blow up twice and then rebuild properly. Marcus is the perfect case study because he experienced both paths. His first attempt at a 10% risk rule felt amazing during the wins. It felt devastating during the losses. By the time he blew up his second account, he was willing to be honest with himself. The position size wasn't a strategy. It was a psychological trap dressed up as aggression. When he rebuilt with a 1% rule, his win rate didn't change, his strategy didn't change, but something fundamental shifted. His losses stopped feeling catastrophic. They felt like part of the process. A 500 loss on a $50,000 account is nothing. It's noise, it's learning. It doesn't trigger the reptile brain's threat response. So he could think, he could adjust, he could survive long enough to actually become good at trading. This is the invisible mechanism that position sizing controls. It's not just about money management. It's about neurology. When your position size is too large, your amygdala hijacks your prefrontal cortex. You're operating from fear and greed, not logic and planning. When your position size is small, your prefrontal cortex stays in control. You can observe, you can learn, you can adapt. The professionals understand this at a bone-deep level. They don't size large because they're confident. They size small so they can stay confident through the inevitable losing streaks. They understand that consistency across 1,000 trades beats the dream of one massive winner. They understand that a 55% win rate with 1% risk compounds into exponential wealth, while a 65% win rate with 10% risk compounds into bankruptcy. The equation is simple but ruthless. ACO. Anti-growth equal Toen radix average win-loss radix average loss. But the psychological sustainability of that growth depends entirely on position size. A strategy with a 55% win rate and perfect discipline at 1% risk will outperform a strategy with a 65% win rate and fractured discipline at 10% risk. Every single time. Marcus's story doesn't end with him becoming rich overnight. It ends with him becoming sustainable. Consistency over 3 years, not heroics over 3 days. A $50,000 account that grew to $150,000 not through a single monster trade, but through 200 winning trades at 1% risk, averaging a 2-to-1 reward. That's the professional's pathway. Boring, slow, absolutely unstoppable. The next layer that separates the 1% survivors from the rest is understanding exactly where to place that sized position. Position size tells you how much to risk, but entry timing, the subject of the next chapter, tells you where to risk it. And that distinction is the difference between a position that keeps you alive and a position that kills you before you even begin. The best position size in the world doesn't matter if you're entering at the worst possible time. That's where confirmation becomes your greatest ally. You see the setup. Your heart says go. Your chart says go. So you go. 90% of traders enter here. The other 10%, they wait for confirmation. Confirmation is the difference between a setup and a trade. A setup is a possibility. The price touches a support level. A moving average aligns. Momentum shifts. All real. All interesting. But not all tradable. A trade is a confirmed reality. Setup appeared, and the market immediately proved it by moving in your favor direction. Here's how pros filter. They watch the tape, the actual price action, for what Livermore called the tape's evidence. Not opinions, not patterns. Evidence. The market either confirms hypothesis or it doesn't. Let's say you identify a support level at $100. Price drops to $100.50. That's a setup. Amateur enters here, hoping. Professional doesn't. Price bounces to $101.20. Now it's confirmation. The market voted. The level held. The bounce is real, not just noise. That's the entry. The amateur's version costs 1.5% to find out it fails. The professional's version costs 0.3% because she entered when probability had already shifted. Over 100 trades, that difference, entering with confirmation rather than setup alone, compounds into the difference between a 45% win rate and a 60% win rate. The rule, never enter a setup without market confirmation. Let the market move into your idea before you move money into the trade. This requires radical patience. The setup will disappear sometimes. The confirmation will never come, and you'll walk away. That's correct. The trade you don't take is often as valuable as the trade you do. Sarah, a trader I mentored, used to enter on setups alone. She'd hit 40% winners, consistent losses. When she shifted to waiting for confirmation, even if it meant missing some moves entirely, her win rate jumped to 58%. Fewer trades, bigger edges, same capital. The psychological shift is massive, from convince me this will work to show me this is working. One is hope, one is evidence. This is also why speed matters less than you think. The confirmation appears in its own time. Your job is ready recognition, not fast execution. But here's what even traders using confirmation still get wrong. They don't know when to hold and when to fold. That's the next frontier. The mathematical precision of what just happened needs to sink in. When the amateur enters at $100.50, she's risking 1.5% of her account to find out if the setup works. When the professional enters at $101.20, she's risking only 0.3%. That's a five-fold difference in capit. Al at risk to achieve the same directional exposure. Over 100 trades this compounds. The amateur is constantly bleeding capital on false setups. The professional is preserving capital and only deploying it when probability is already shifted in her favor. This is the invisible advantage that separates the traders who compound wealth from the traders who compound losses. It's not that the professional strategy is fundamentally better. It's that she's executing the same strategy with infinitely better risk management at the entry point. She's waiting for the market to prove the setup before she commits capital. Think about what confirmation actually means from a psychological perspective. A setup is your thesis, it's your analysis. It's what you think should happen based on price history, support levels, moving averages, or whatever your methodology includes. Confirmation is the market proving you right before you risk serious money on it. The market is saying, yes, this setup is real, price is moving where you predicted. That's the moment to act. The amateur trader misses this entirely. She sees the setup and immediately substitutes her analysis for market proof. She thinks, this is textbook, this always works, I should enter. But the market doesn't care about textbooks. The market doesn't care about historical patterns. The market only cares about what's happening right now. And right now, at $100.50, the setup hasn't proven itself yet. It's just a hypothesis waiting for evidence. Sarah's journey illustrates this with brutal clarity. When she was entering on setups alone, her 40% win rate made sense. She was entering on probability, not confirmation. Maybe the setup has a 60% theoretical success rate based on historical data, but that's an average across thousands of occurrences. In any single instance, the setup could fail. The market could drop through support. The bounce could be a false bounce. The moving average could be a trap. But when Sarah waited for confirmation, when she saw the price actually bounce off $100 and rise to $101.20, she was entering when the setup had already started working. The probability had shifted. The market had shown its hand. Her win rate jumped from 40% to 58%. That's an 18 percentage point improvement from a single rule change. Wait for confirmation before entering. This also answers a question that most traders never ask themselves. Why do professional traders seem to take fewer trades than amateurs? It's not because they're lazy or picky. It's because they're waiting for confirmation. A professional trader might see 10 setups in a week. She enters 3 of them because only 3 received market confirmation. An amateur trader sees the same 10 setups and enters all of them, hoping for the best. The amateur takes 3 times as many trades and loses money on most of them. The professional takes fewer trades and wins on most of them. This is the power of the confirmation filter. It's not just about improving your win rate. It's about respecting the market's voice over your own analysis. The chart pattern you identified might be real, but the market's confirmation of that pattern is more real. Always choose the market's evidence over your own thesis. The market will teach you whether the setup works before you've committed serious capital to finding out. The tape's evidence is also more objective than your analysis. Your analysis is filtered through your beliefs, your biases, your hopes. You see a pattern because you want to see it. You interpret it favorably because you're already psychologically invested. But the tape doesn't lie. The tape just shows price movement. If the setup was real, the price will move in your predicted direction. If it was false, the price will move against Y. Confirmation waits for that objective movement before you enter. This is why speed becomes secondary in the confirmation framework. You don't need to be fast, you need to be ready. By the time confirmation arrives, you already know exactly what you're looking for. You've already decided where you'll enter, how much you'll risk, where your stop will be. You're just waiting for the market to show you the green light. When it does, execution is instantaneous. But all the thinking happened during the waiting period. The psychological shift that Sarah experienced is the deepest part of this rule. She moved from "convince me this will work" to "show me this is working." The first is hope-based. The second is evidence-based. Every amateur trader operates from hope. Every professional trader operates from evidence. Hope says this pattern worked last time, so it should work now. Evidence says this pattern is working right now, so I'll participate. Hope is where money dies. Evidence is where money is made. This also circles back to the position sizing rule from Chapter 2. If you're sizing at 1 to 2% per trade, you can afford to wait for confirmation. You're not so desperate to trade that you'll enter on hope alone. You can afford to miss the setup that doesn't confirm. You can afford to wait for the next one. But if you're sizing at 5 to 10% per trade, you feel pressure to make every trade count. You feel like you can't afford to miss. So you enter on the setup alone, without confirmation. You're pressuring yourself into emotional decision-making because your position size is too large. Position size and confirmation work together. Position size keeps you in the game long enough to be patient. Confirmation keeps you from entering until the market has proven the setup. Together, they create an entry methodology that is simultaneously disciplined and high probability. The trade. RS who master confirmation aren't the ones who trade the most. They're the ones who trade the best. They're the ones who look at their trading logs and realize they've made more money on fewer trades, fewer opportunities, higher quality, fewer entries, higher win rate, fewer trades, exponential growth. This is the professional's quiet advantage, and it starts with a simple rule. Never enter until the tape confirms. You're in a trade. It's working. Price is moving your direction. Your profit is climbing $200, $500, $1,200. And now comes the moment that defines your entire career. Do you let it run, or do you take the win? Amateurs overthink this. They have no plan. So when profit appears, they panic and grab it. When a loss appears, they freeze and hope. This backwards instinct, sell winners, hold losers, is the definition of a death spiral. Professionals have the opposite reflex. They let winners run according to plan and cut losers without negotiation. Here's the secret. The exit plan must exist before you enter. Not during, not after, before. When you're sizing the trade, you're also deciding, if this works, where's my first exit? Where's my runner exit if momentum extends? And where's my hard stop? All three, pre-decided. Why? Because emotions are weakest before you have skin in the game. Once profit or pain arrives, your brain hijacks you. A trader I knew, David, would set a 2-1 risk-reward ratio on every trade. He risked $100, he wanted $200 minimum. When price hit that $200 target, he exited half. Let the other half run with a break-even stop. This created free trades, positions where he couldn't lose, so he could think clearly about when to extend. This single rule, exit half at 2-1, trail the rest, transformed his trading from 45% winners averaging plus $150 into 48% winners averaging plus $340. Same win rate, different exits, massive difference in results. The A. Mateer's version, emotional exit decisions in real time. Professional version, exit rules written before entry. Here's the paradox. The traders who make the most money often feel like they're exiting too early. They don't swing for home runs. They take singles and doubles consistently. Over a year, singles and doubles compound into real wealth. The exit rule isn't about greed. It's about consistency. A small win repeated 200 times is worth more than a huge win chased once and missed 50 times. But there's one more layer that almost no trader implements. It's the difference between knowing these rules and actually living them. And that's where discipline architecture comes in. The final framework that locks everything together. The moment you enter a trade is also the moment your brain starts working against you. Before you had skin in the game, you were analytical. You sized correctly, you waited for confirmation, you were methodical. But the second profit or loss appears on your screen, your amygdala floods your system with neurochemicals. Your prefrontal cortex, the rational part, gets suppressed. Your threat and reward system takes over. This is why every trader's exits are worse than their entries. The entry was made calmly. The exit is made in panic or greed. This is also why pre-planning the exit is so critical. You need to decide your exit rules during the state of maximum rationality, before you have money on the line. The moment you're up $1,200, your brain is flooded with oxytocin and dopamine. You're not thinking clearly. You're thinking maybe this runs to $5,000, or I should lock this in before it reverses. Neither of those thoughts is analytical. Both are emotional. But if you've already decided in advance that you're exiting half at 2-1 and trailing the other half, you don't have to think. You just follow the plan. David's framework is elegant because it solves multiple problems simultaneously. First, it guarantees that you lock in profit. Half your position exits at 2-1 risk-reward, which is a solid, repeatable return. You're guaranteed to go home with something. Second, it gives you the psychological permission to let the other half run. Because you've already secured half your gain, you're not tempted to exit everything. You can trail the other half with a break-even stop and let it extend if the market gives it to you. This is the free trade concept. You're no longer risking your own money on the runner. You're risking the market's money. Think about the psychological architecture of that approach. An amateur trader is in a position that's working. She's up $1,200. Her brain is screaming two contradictory things: lock it in before it reverses, and let it run, it could go higher. She's paralyzed by this conflict, so she makes an emotional decision in real time. Sometimes she exits too early. Sometimes she holds too long and watches the profit evaporate. Her exits are inconsistent because they're emotionally driven. David's exits were consistent because they were pre-planned. He never had to wonder whether to hold or sell. He already knew. Sell half at 2-1. Trail the rest. The decision was made before the trade existed. So when the profit arrived, he didn't feel conflict. He just executed. This is why David's results improved so dramatically. His win rate went from 45% to 48%, a modest 3 percentage point improvement. But his average win went from $150 to $340. That's more than double. Over 100 trades, that's the difference between making $7,500 in gross profit and making $15,200. Same number of winners. Different exits. Exponential difference in results. The paradox that David experienced is one of the most counterintuitive truths in trading. The traders making the most money often feel like they're exiting too early. This seems backwards, but it's actually the definition of disciplined trading. An amateur feels like he's exiting too early because he's constantly dreaming about what could have been. The trade went from $1,200 to $3,000 after he exited. He feels like he left money on the table. But David doesn't have time to think about what could have been. He's already moved on to the next setup. He's already made his profit. He's already exited half and secured it. He feels no regret because he has no emotional investment in the what-if. This is also the fundamental difference between hoping for a home run and compounding steady singles and doubles. Every amateur trader has a fantasy of catching one massive move, the stock that runs from $50 to $200, the cryptocurrency that goes from $100 to $10,000. If only they could hold that one trade, everything would change. So they hold winners too long, hoping for the home run. Meanwhile, the winners they do hold turn into losses. The momentum they were riding reverses. They end up exiting at break-even or with small losses. Over a year, this behavior, holding winners too long, hoping for the moon, costs them dearly. The professional trader has a different fantasy. It's not about one massive trade. It's about 200 consistent trades at $340 average profit. That compounds into $68,000 in profit. That's wealth. That's sustainable. That's repeatable. And it's built on the discipline of exiting half at 2-1 and trailing the rest according to plan. The mathematical reality is brutal. A small win repeated 200 times compounds. A huge win chased and missed 50 times does not. If you make 50 home run swings and miss 40 of them, you're left with 10 winners. If those 10 winners average $3,000 each, you've made $30,000. But if you took 200 small wins at $340 each, you've made $68,000. The disciplined trader double. The undisciplined trader's results, and she does it with less stress, less risk, and more consistency. This also reveals why the amateur's backwards instinct, sell winners, hold losers, is so destructive. When you exit winners too early and hold losers too long, you're creating a portfolio of bad trades. Your winners are small and numerous. Your losers are large and concentrated. Your average trade is negative. Over time, this kills accounts. But when you flip that instinct, hold winners according to plan, exit losers immediately, you create a portfolio of good trades. Your winners are reasonably sized. Your losers are small and contained. Your average trade is positive. Over time, this creates wealth. The exit rule is also where the amateurs finally realize they've been doing it backwards their entire careers. They've been thinking about exits emotionally. How much profit do I want? Or how much pain can I tolerate? But the professional thinks about exits mechanically. What is my risk-reward ratio? Or where is the next technical level? The amateur is trying to feel her way to the right exit. The professional is calculating her way to it. Pre-deciding the exit also solves another critical problem. It prevents you from moving your stops. An amateur trader enters a trade with a stop at a certain level, but as the trade goes against him, he's tempted to move the stop lower to give it more room. He's hoping the reversal will come. It doesn't. He ends up taking a much larger loss than he originally planned. A professional trader has already decided where her stop is. She's moving her stop only in one direction, tighter, toward break-even. She never widens the stop to give a losing trade more room. She never hopes. She just executes. David's framework, exit half at 2-1, trail the rest, is one answer to the exit problem. But the principle is broader than that specific rule. The principle is, decide your exits before you enter, and then execute them mechanically when the market reaches those levels. Consistency in exit discipline creates consistency in results. And consistency in results, compounded over time, creates real wealth. This is the quiet power of the exit rule, and it's invisible to most traders until they have already lost enough money to finally pay attention. You now know the rules. Position size, confirmation, exit plans, they're not complicated. But here's what separates the traders making money from those burning accounts. They've built a system that makes following the rules inevitable, not optional. This is discipline architecture. An amateur follows these rules for 2 weeks. They feel tedious, slow, limiting. Then they break one. Just this once, I'll take a bigger position. Or this setup looks so obvious, I don't need confirmation. Or I'll hold this winner a bit longer. Just once becomes twice. Twice becomes standard. And then they're back to blowing up. Professionals prevent this by building their system into their environment, not just their mind. They use position calculators that won't let them risk more than 1 to 2%. They use alerts that trigger on confirmation signals, not on hunches. They set hard stops that are mechanical, not discretionary. They use trader journals that force accountability. The goal is to remove decision-making from moments of emotion. James, a trader I've worked with, takes no discretionary trades. None. His entire account is managed by pre-written rules in a trading platform. Price hits a confirmed setup. A stop is placed, a position is sized. He executes. He journals. He reviews. That's it. Does he miss trades? Yes. Does he sometimes watch price do exactly what his rules predicted and not participate? Also yes. But he hasn't had a losing month in 3 years. Compare that to Mark. O trades the same time frame, same instruments, same general strategy, but executes manually. He's up about 35% some years, down 15% others. Inconsistent, emotional, exhausting. The difference isn't intelligence or market insight. It's architecture. You need 3 elements. 1, a position sizing calculator. 2, a confirmation filter, price action alerts. And 3, a trading journal. These 3 items used consistently will eliminate 80% of the mistakes that kill traders. The final piece is also the hardest: patience. Not the patience to wait for confirmation, that's mechanical, but the patience to not trade when setups don't align. Doing nothing is a valid position. In fact, it's often the best one. This is the professional's greatest secret. Knowing when not to trade is more valuable than knowing when to trade. The gap between knowing what to do and actually doing it is where most traders die. They've read the books. They understand position sizing. They can identify setups. They know they should wait for confirmation. And for the first 2 weeks, they follow the rules. They're disciplined. They're excited. They're convinced this time will be different. Then the rules start to feel constraining. A setup appears that's obviously going to work. They skip the confirmation filter. Just this once, they tell themselves. It works. They make money. And now their brain has learned something dangerous. Breaking the rules can be profitable. The next time a setup appears without confirmation, the temptation is stronger. They break the rule again and again. Within a month, they're back to their old habits. By month 2, they've blown up again, and they're left wondering why they couldn't stick to the plan. This is the amateur cycle, and it repeats endlessly. The problem isn't the rules. The rules are solid. The problem is that the rules rely on willpower, and willpower is a finite resource. You can be disciplined for a short time. You can be disciplined when the market is calm and setups are clear. But when the market is volatile, when opportunity is screaming at you, when your emotions are heightened, willpower fails. Everyone's willpower fails eventually. The solution isn't to try harder. The solution is to remove the need for willpower. This is what discipline architecture actually means. It's not about being more disciplined. It's about building systems that make discipline automatic. It's about making the right decision the path of least resistance. James doesn't need willpower to avoid oversizing because he can't oversize. His position calculator won't allow it. His trading platform has hard limits built in. He doesn't need willpower to wait for confirmation because his alerts only trigger when confirmation appears. He doesn't need willpower to stick to his stops because they're mechanical, not discretionary. He's removed the human element from the equation, which means he's removed the emotion. Mark, by contrast, is fighting willpower battles every single day. He's trying to manually manage position sizes. He's trying to recognize confirmation signals on his own. He's trying to mentally honor his stops. He's trying to journal consistently. All of this requires constant discipline. Some days he has it, some days he doesn't. On the days he doesn't, he trades poorly. Over a year, his inconsistent discipline creates inconsistent results. He's up 35% some years, down 15% others. That's not because he lacks intelligence or market knowledge. It's because his system relies entirely on his ability to be disciplined in real time, and real time is exactly when discipline is hardest. The 3 pillars of discipline architecture are simple but non-negotiable. First, a position sizing calculator removes the discretion from position sizing. You input your account size, your risk per trade, and your stop-loss distance. The calculator tells you exactly how many contracts or shares to trade. No thinking, no guessing. No, maybe I can go a bit bigger today. The calculator has spoken. You trade that size, or you don't trade at all. This alone eliminates one entire class of trading mistakes, the oversized position that ruins your month. Second, a confirmation filter removes the discretion from entries. This could be price action alerts that trigger when price breaks through a level, or moving average crossovers, or whatever confirmation rules you've decided on. The key is that you're not deciding in real time whether the confirmation is valid. The system is telling you when to enter. You're just executing what the system says. This eliminates the guesswork from entry timing and prevents you from entering on hunches or hope. Third, a trading journal creates accountability. Every trade you take goes into the journal. Every entry, exit, profit, loss, and reasoning. At the end of each week or month, you review the journal. You can see exactly where you made mistakes. Did you enter without confirmation? Did you oversize? Did you hold a loser too long? The journal shows you. This creates a feedback loop that improves your decision-making over time. But more importantly, the knowledge that you'll be reviewing the journal creates a psychological brake on impulsive trading. You know you'll have to justify your trades later, so you're less likely to make stupid ones now. These 3 elements work together to create a system that's self-enforcing. The calculator enforces position sizing. The alerts enforce confirmation. The journal enforces accountability. Together, they make following the rules the easiest thing to do, not the hardest. You're not swimming upstream against your emotions. You're swimming downstream with your system. James's 3-year streak of no losing months isn't luck. It's architecture. He's designed a system that catches him before he makes expensive mistakes. If he tries to oversize, the calculator stops him. If he tries to enter without confirmation, the alerts don't trigger. If he tries to break the rules, the journal will show the evidence. He's given up some discretion, yes. He sometimes watches trades that work and didn't participate because his rules didn't trigger. But those missed trades are the price of not blowing up. That's a price worth paying. Mark's emotional ride, up 35% some years, down 15% others, is also not luck. It's the natural result of a system that relies entirely on willpower. When Mark is motivated and the market is cooperative, he trades well. When Mark is frustrated or the market is volatile, he makes mistakes. Over a year, he makes some very good decisions and some very bad decisions. His results are the average of those good and bad decisions. Because he has no system to protect him, his results are inconsistent. The hardest part of discipline architecture, though, is the final element, patience to not trade. This isn't about waiting for confirmation. This is about waiting for setups to align at all. It's about having the discipline to sit in cash for hours, days, or even weeks, waiting for your exact setup. This is where most traders fail. They get bored. They get FOMO. They feel like they should be doing something. They convince themselves that a lesser setup is good enough. They start trading setups that don't quite meet their criteria. They lower their standards. And suddenly they're back to trading like an amateur again. James doesn't struggle with this, because his system is clear about what qualifies as a trade. If the setup doesn't meet the criteria, the alerts don't trigger. He's not sitting there sweating about whether to TR. A marginal setup. The setup either qualifies or it doesn't. If it doesn't, he's in cash, and that's the correct position. Doing nothing is the correct trade. This is the professional's greatest secret. Knowing when not to trade is more valuable than knowing when to trade. Most traders never learn this. They think the goal is to be in a trade as much as possible. The real goal is to be in a good trade as much as possible, and that often means doing nothing. The three-pillar architecture, position calculator, confirmation alerts, trading journal, is the practical embodiment of this philosophy. It makes the professional's approach accessible to anyone willing to implement it. You don't need to be a genius. You don't need to predict the market. You need to be disciplined enough to build a system and faithful enough to follow it. That's the entire game. That's what separates the traders making money from the traders burning accounts. Here's where everything converges. Every rule you've learned, position size, confirmation, exit discipline, architecture, all of it rests on one principle. The tape is truth. The market doesn't lie. It doesn't care about your opinion. It doesn't validate your research or respect your conviction. It simply moves. And that movement is the only signal that matters. Amateurs read about the market. They form opinions. They argue their thesis. Professionals read the market. They form observations. The difference is humility. You can be right about fundamentals and wrong about timing. You can understand the reasoning and misread the momentum. You can have the best setup in the world and enter at the worst moment because you didn't wait for confirmation. The tape shows all of this in real time. A professional trader watches tape action like a hunter watches prey, not to judge it, to track it, to recognize patterns, not to predict, but to react when E pattern confirms. This is why speed matters, but only after confirmation. The market shows you something. You've already decided what to do if it shows that. You execute fast because your decision was made slowly. This is also why most traders fail. They're trying to predict the tape. Amateurs want to be right first. Professionals want to be profitable always. Being right first is ego. Being profitable always is discipline. The tape doesn't care about your analysis. It cares about your execution. It rewards the trader who sizes small, enters on confirmation, exits on plan, and stays in the game long enough to compound. Over 5 years, the trader who follows these rules, boring as they are, will outperform the trader who's right more often but bigger, messier, and emotionally volatile. Here's your closing framework. Size small, wait for confirmation, exit on plan, and build architecture that makes all three inevitable. Do these 4 things for 2 years, and you'll be in the top 5% of traders by income and consistency. The rules aren't secret, they're just discipline. And discipline isn't talent. It's choice. You now have both. The only question is what you do next. The tape is the market's voice, and the market is always speaking. Every candlestick, every tick, every movement at every time frame is the market communicating something. It's showing you what the smart money is doing. It's showing you where the orders are. It's showing you where the pressure points are. But most traders don't listen to the tape. They listen to their own opinions instead. They've read an earnings report. They've studied the fundamentals. They've formed a thesis about where the stock should go. And now they're waiting for the market to validate their thesis. The market doesn't care. The market will do what it will do, regardless of your thesis. And when the market moves against your thesis, why? Have a choice. You can argue with the market, or you can listen to it. This is the fundamental epistemological difference between amateurs and professionals. The amateur trader is trying to be right. She's invested her ego in her analysis. She's convinced herself that her thesis is correct. So when the market moves against her, she holds, hoping the market will eventually agree with her. She's waiting for the market to validate her intelligence, her research, her conviction. The professional trader doesn't care about being right. She cares about being profitable. She forms a hypothesis about what the market will do. The market either confirms that hypothesis or it doesn't. If it confirms, she profits. If it doesn't, she exits and moves to the next hypothesis. She's not waiting for validation. She's waiting for evidence. The tape provides that evidence in real time. Every price movement is a vote. Every order is a statement. The professional reads those votes and statements and adjusts accordingly. When the tape shows her that her hypothesis was wrong, she exits. When the tape shows her that her hypothesis is right, she lets it run. She's not trying to predict what the tape will show. She's reacting to what the tape is already showing. This is why confirmation is so critical. Confirmation is the tape's way of saying, yes, this is real. The setup is the professional's hypothesis. The confirmation is the tape's validation of that hypothesis. Only then does she risk capital. This also explains why being right more often doesn't make you more profitable. An amateur trader could have a 70% win rate and still lose money. How? By sizing too large on her winners and too small on her losers. By exiting winners too early and holding losers too long. By being right about the direction but wrong about the timing and entry. She's technically right more often, but her execution is poor, so her bottom line is negative. A professional trader could have a 55% win rate and make exponential wealth. How? By sizing small, entering on confirmation, exiting on plan, and never deviating from the system. She's right less often, but her execution is excellent, so her bottom line is strongly positive. The tape doesn't care about your win rate. The tape doesn't grade you on your accuracy. The tape only cares about your execution. Did you size appropriately? Did you enter when probability had shifted in your favor? Did you exit according to your plan? Did you preserve capital during losses so you could compound during wins? If yes to all of these, the tape will reward you. If no, the tape will punish you. The tape is brutally fair and utterly indifferent to your feelings about it. This is why reading the tape like a hunter watches prey is the right metaphor. A hunter doesn't predict what the deer will do. She learns what deer typically do. She recognizes the signs of deer behavior. She positions herself where deer are likely to appear, and then when the deer appears, she reacts. She doesn't debate with the deer about whether it should be there. She doesn't second-guess her decision to be a hunter. She just executes on what she sees. The professional trader operates the same way. She's learned what price action typically looks like before a move. She's recognized the early signs. She's positioned herself, size small, planned her exits for when the move appears. And then when the tape confirms the move, she executes. The profitability over 5 years is where the math becomes undeniable. A trader with a 65% win rate but poor execution, exiting winners too early and holding losers too long, might make 35% per year. A trader with a 55% win rate but excellent execution, following all the rules religiously, might make 50% per year. Over 5 years, the first T compounds his capital by 1.355 equal to 4.67 times. The second trader compounds her capital by 1.505 equal to 7.59 times. Starting with $50,000, The first trader ends with $233,500. The second trader ends with $379,500. Same market, same time frame, different discipline and execution. The tape rewards the disciplined trader exponentially more than the undisciplined one. This is also why the amateur's obsession with being right first is such a costly mistake. She wants to prove she's smart. She wants to be the person who called the move before it happened. She wants to be right on the analysis. But the market doesn't care about any of that. The market cares about what you do when it moves. The amateur wants to enter before the move. The professional wants to enter after the move has started. The amateur is trying to prove intelligence. The professional is trying to make money. These are fundamentally different goals, and they lead to fundamentally different behaviors. The closing framework brings it all together in a simple, repeatable formula: size small, wait for confirmation, exit on plan, and build architecture that makes all three inevitable. These aren't novel insights. They're not the product of genius. They're the product of humility. The humility to admit that you can't predict the tape. The humility to wait for evidence before you risk capital. The humility to follow a plan instead of trusting your gut. The humility to build systems instead of relying on willpower. This humility is what separates the top 5% from the bottom 95%. The final maxim, discipline isn't talent, it's choice, is the empowering closing statement that reframes the entire conversation. You don't need to be naturally gifted to become a profitable trader. You don't need genius-level market insights. You just need to choose discipline. You need to choose to size small even when you want to go big. You need to see who's to wait for confirmation even when you want to enter on hope. You need to choose to exit on plan even when you want to hold for more. You need to choose to build systems even when you want to trade by feel. These are all choices, and choices are available to anyone. The tape will listen to anyone who listens to it. The tape doesn't discriminate. It rewards discipline and punishes lack of discipline regardless of who's trading. You now have the rules. You now have the framework. The only question left is whether you'll choose to implement it. That's the conversation for the next video.